Hello and welcome to Mint Funds Update. My name is Marek Krzeczkowski and I'm joined by Ryan Falls. And today we'll talk about market update and what happened within diversified funds last month. Just starting with the US economy, and we have seen a very sharp sell-off in the markets over the last week. I just wanted to briefly explain what has actually happened. And I know people wrote different articles of what was causing the sell-off, but what we believe has happened is really a surprise that came out of Trump's announcement of tariffs. We all expected to see some tariffs coming to the last week's announcement. However, nobody expected that the formula they use is something which is completely unrelated to tariffs and makes no economic sense. In fact, the quote that you can see here on the left-hand side comes from a very conservative think tank. So it's not a view of some, enemies of Trump. But the reason really for making no sense is that this tariff is simply taking trade deficit and then divided by imports, right? Which has nothing to do with tariffs. Now, the other thing which surprised the market, and that perhaps was the biggest concern, was just the size of these tariffs and how the calculation was made. So let me just explain this very, very quickly. So Trump showed the formula on the left. His administration quoted this formula as the main reason for the tariffs. But just to explain it, and if you want to understand how we ended up with penguins in Antarctica paying 10%. So imagine you levy a tax on goods coming from other countries. And then you think about trade balance. The effect on the trade balance depends on how much the prices of those goods will rise. Now, the Trump's administration in the calculation assumed that price rise only a little when those taxes go up. So they used, I highlighted here in red, the ratio of 0.25. In reality, based on a number of research studies of previous tariffs, prices actually nearly match the tariff increase. So it should be more like 1. As a result, all calculations are off by almost 4 times. Now, if we calculated the tariffs properly following this formula, what you would end up is actually no country would exceed 14%, and most countries would actually end up with 10% that was imposed by Trump's administration. So countries like China that have been charged with 34% would actually be 10%. Now, this is what markets expected. Markets expected to see something around the 10% level, but no one expected to see tariffs that you see here in the middle column. Now, obviously, the question is what happens next. Now, markets have sold off really sharply on the back of that announcement. Within 2 days, we've seen one of the fastest sell-offs on the record. This is the third fastest sell-off in the history of S&P 500. And the question is, what happens next? We believe that these tariffs are still a negotiating tool. We have some early signs of Trump already announcing that 50 countries are talking and trying to negotiate them down. We just today had announcements from EU willing to come to 0 tariffs. So at the end of the day, it feels like Trump is trying to get a deal and then we obviously don't know the timing, couple of weeks from here, he will be able to say, look, for 50 years, we have been paying those unfair tariffs and I solved it all in 2 weeks. That's obviously is a very politically motivated, but nevertheless feels like it is the end game, what we're trying to do. So obviously, if these tariffs are not called off, we will see a contraction. On the left-hand side, you see, if you take those tariffs and then you also look at second order effects, so slowdowns and so on, you will be looking at a significant contraction in the earnings per share growth moving forward. But on the right hand side, there's obviously a question of where is the bottom, or where is the value, right? Where you should be looking at the value. And with S&P 500 around that 5,000 point, we believe that if you are looking purely from valuation point and assuming that there won't be a severe recession, so assuming that at some point Trump will actually back off from those reciprocal tariffs and come back to a common sense, then some investors would actually find it attractive, to buy into equities at these levels. Now, obviously, we don't know what will be announced, but it feels like equities have moved sharply down to price recession. So if some concessions came in over the coming weeks or even days, we would expect a sharp bounce back from those lows that we see today. So overall, obviously the key message for us is maintain long-term focus. We staying invested. This is what people say. Too late to panic, and I think we just need to see how those tariff negotiations play out over the coming days and weeks. But overall, we are still, we believe that probability of recession in the US has increased significantly after last week's announcements, but we still believe that there is a path for US economy to avoid recession this year.
Thanks, Marek. Looking now at the domestic New Zealand economy, just reflecting back on what we had going on in March, we actually had a positive surprise with the Q4 GDP print. It came in at plus 0.7%. So this is against the market expectations of plus 0.4 and plus 0.3, as you can see from the chart. However, I guess the thing to note is there is storm clouds on the horizon with the threats to global growth that Marek has alluded to from the US tariff wars that have started. So just to flag that in the short term, these expectations from the RBNZ looking at March, June, September, December 25, they're all around the 0.6, 0.5% quarter-on-quarter growth. They could be under threat in the short term just from some of the volatility arising from these tariffs and the second order effects affecting other countries. Okay, now turning now to the diversified funds, and we'll start with the diversified income fund. So asset class performance was negative in March as markets waited nervously on the US reciprocal tariff news, causing growth concerns to permeate both equity and bond markets. Within the individual asset classes, we had fixed income coming in flat, with global and Australasian equities both negative contributors for the month at minus 0.9% and minus 0.8% respectively, giving us an overall fund return of negative 1.7%. Turning to the positive contributors within fixed income, New Zealand rates followed the US and steepened further on the back of increasing worry around those reciprocal tariffs. Markets kind of looked through the big upside surprise on New Zealand Q4 GDP, the 0.7 versus 0.3 expected. And then also during the month, we brought our short duration exposure back to neutral. This is to reflect the potential challenges for global growth. Within global equities, we had Cigna Group up 6.5% and Fidelity National Information Services up 5%. They're the top two positive contributors. Cigna Group defensiveness helped against a weak market backdrop. And then also during the month, they announced leadership changes to accelerate their new growth strategy. In Australasian equities, we had Serco Limited up 8.2%. That was a top performer in March. The stock surged on news that has suggested it is on track to blow past the top end of its income guidance for this financial year. Looking at the negative contributors for March, within global equities, we had Novo Nordisk down 27.1% and Tapestry Incorporated down 17.6%. Novo Nordisk actually slid after its planned Ozempic successor, CagriSema, failed to impress market participants with poor results in the clinical trial results. Within domestic equities, we had Megaport down 13.4%, and that was the main attractor for performance this month. So given exposure to global growth as well as high beta to US tech, in a month where they all sold off, Megaport suffered on wider negative sentiment rather than any specific news events. Turning now to the Mint Diversified Growth Fund, and again, obviously, asset class performance was negative in March, and it was all off the back of that US reciprocal tariff news, particularly for equity markets and then some for bond markets. So again, we had fixed income coming in flat with global and Australasian equities, both negative contributors at minus 4.5% and negative 0.8% respectively. And that gives us a fund return of negative 5.3%. Looking at deposit contributions within global equities, we had Fidelity, National Information Services again up 5%, and then Comcast Corporation was up 2.8%. Fidelity actually surged after the CEO indicated that they were a little conservative in their previous Q1 earnings guidance, which led markets to reprice in higher expectations for those earnings. In Australasian equities, we had Circle up 8.22 and then Channel Infrastructure up 3.4. So Channel actually rose as they announced the sale of their Z Energy equity holding of their business during the month. And again, within fixed income, we reduced our short duration exposure back to neutral, on all the back of those concerns for global growth, and then its impact on the long end of the New Zealand yield curve. Looking at negative contributors, within global equities, we had Novo Nordisk down 27.1 and LVMH down 17.7. So LVMH actually slid as fears on those reciprocal tariffs directed at the EU from the US administration would hit their revenue significantly. Within domestic, again, we had Megaport down 13.4 and then Somerset Group down 7.8. Somerset slid on continued weak news out in March from the New Zealand property sector, with the long reported recovery seeming a long way off. And that's all from me.
Thank you for listening. And if you have any questions, please send them to info@mintasset.co.nz.